Hey everyone, it is Jay Soloff here at Investors Alley, and this is our options trade of the week. I am at marketchameleon.com looking, as I like to do normally, at this unusual options volume page, which has got a table that shows stocks that have options that trade significantly more than their 90-day average. So this is certainly unusual activity. Now, it can be something that trades a lot of volume and is still relatively more than it normally is, or it might be something that doesn't trade a lot at all, and just the fact that there's volume in it at all is a big difference. So we're going to look at the former. We're going to look at some stocks here that are trading, that generally trade a lot, but are trading even more. So for instance, Tesla, Amazon, Intel, Twitter, these are all really big names that trade a lot. The reason that these are all up here trading a ton is they've all had earnings over the last couple days. So that's no surprise. And what's interesting though with these big ones is that there's a lot more activity in there and a lot more complex type stuff. So you're going to see more even split between calls and puts than you might with a stock that doesn't trade as much, and it just might be a bunch of people buying calls or buying puts or some sort of directional play on a smaller name. In this case, there's a lot more stuff going on, and so it's going to be a little bit more even. So even something like like Intel had really great earnings, and you could see 67% calls, but if this was a sort of a no-name stock, that might be 100%. There might be zero puts trading and all calls now, but you could clearly see that they had really good earnings, as evidenced by the 67% calls versus 33 puts. Now, here's an interesting one though. Twitter had actually really negative news. They had a technical glitch which really hurt their advertising revenues, and the stock was way down. It was as high as 38 when the news came out. Now it's down to under 31. But a lot of the activity here is calls and not puts. So we can sort of hone in on that and maybe see what's going on here. So you could see it was down today 1.5%, but yesterday it was down. It was as high as 38, or when the earnings came out, it was around 38. It was closing in on 40, and now we're all the way down to 30. So obviously a really big drop. But that didn't stop people from buying calls. So we kind of look at some trades here, and we can see a lot of the stuff that's called out here is put activity. But what we saw from that, here's some call spreads. Here's a few other things. But what we saw from that graph, or that table, that a lot of the activity was in fact in calls. So there might have been a lot more smaller call trades. Now here's a big one, 1670. So obviously this is here is probably one of the things that added to that unusual volume, and it looks like maybe someone is taking a bet that Twitter is going to recover by the end of the year. So looking at the details, now this was actually traded on the bid. Now normally if someone hits the bid, it means they're selling the call. However, in this case, we're talking about a 1 penny wide spread, 134, 135. So this could have gone either way. If it's only a penny wide, you don't know. I mean, someone could have put a bid at 134, and there might have been someone looking to sell that didn't really care between 135 and 134, right? So in this case, I wouldn't necessarily say that just because they hit the bid, it was a sell. And my guess is this was a purchase, particularly after a big drop in the stock. I wouldn't expect someone to sell almost, at the money calls like this. That's, maybe not part of a cover call or something like that. I mean, you never know. There might have been, this might be part of a bigger strategy, but my guess is someone is taking a flyer here, because really the news on Twitter, if you were to look at it, it was pretty temporary, right? The big thing there was a technical issue that hurt revenues. That's the sort of thing that should be recoverable over time, and so maybe someone is betting that investors are going to come back once they realize it's not as big of a deal, and so they're taking a flyer on a decent chunk, $223,000 worth of calls that could make a significant amount of money if this thing shoots over around 32.5 or so. So just a reasonable recovery, and maybe if the market rallies to the end of the year, and something like Twitter will go with it. So just an interesting sort of trade, a flyer, something you can easily do in your own account, or you could use a call spread even if you want to cut down on your costs a little bit. But just interesting to see a lot of call activity after negative earnings, and that could be a sign that investors are not buying that Twitter is going to stay down for the longer term, and that it could be a bounce back candidate. If you want to learn more about these sort of strategies, you can look at my option trading mastery course. That's it's got a link on this page. It covers all different kinds of strategies and 11 different videos in a 5 to 6 hour block that you could look and record your progress. And so might be worth checking out if you're interested in learning more about this stuff.